We're going to go ahead and take a look at a couple of things today as we get into the live markets. So I got a couple questions here from my Discord people were asking me about. So I'm going to go ahead and answer some of those. And we'll go in and take a look at the spreads as well. So one thing I do want to note, and just a quick announcement, besides the disclaimer, we're going to do that trading journal that I have available for you guys. I was working on it a little bit the other night, and I've kind of expanded it further with some more stuff. And once my assistant gets finished up putting it together for you guys, from the on the website, we'll get the shareable link and everything, so you'll be able to download that if you want. It's because I added a bunch of fields here as well with some records and months and everything, so that way you could have a cool clean cut journal. Anyway, let's take a look at kind of the overall markets here as we get going. I was posting a lot of different videos and content today just on doing some technicals just for fun. A lot of times with these markets, they're kind of very whippy, so I just posted a few quick videos. Some of the popular stocks, some of the less popular stocks this week, because we got a lot of earnings stuff. So usually my thought and advice as far as earnings go is if you're trading, let's say, less than 1 year, meaning you're holding less than 1 year, then you want to avoid trading through earnings. The only time that rule can kind of be broken is, let's say you had 100 shares and then the earnings are coming up, you sell 90 shares and then you keep like 10. If you're doing it on the option side, then there are specific strategies to trade earnings rather than holding your option contract. Like, let's say you did a spread of some sort vertical and it's going up, and then the earnings are coming around the corner, then that spread was not for earnings. Then get out of it and set up a new trade for earnings, because it's going to behave differently. So with a lot of volatility here coming into play, there's some key significance to what's going on here in the marketplace. We've got some major breaks at the 450. I was talking to one of my coaching and mentoring people about that price level earlier that week, and if we break it, that could be trouble. And that's where we're kind of in right now with the SPY. The IWM looks worse. So when you look at this right here, we had a sideways consolidation in 2021. So that was sideways, and this was support. We tried to even break through it once, and now right here, we're done. This now looks like it's going to be trending downward rather than a trend to the upside. It appears to be downward. Now, it is only just a couple days in, and these things can reverse very quickly because we have been selling for quite a while. There is kind of this A to B, B to C, C to D pattern. So you could get this trend to the upside for a bit, and it's going to look very good. It's going to suck you in. They love to suck you in. It's going to suck you into the upside. It's going to feel good. It might even go above it a bit, and then it could roll over. So watch out for this. This could be a very big head fake that I would just be careful about. Not saying that if it breaks back to the upside right here and then it holds, it could do that as well. But I'm just saying, like, the head fakes that people get sucked into is kind of right here, and then it just rolls over. So those are things to really watch out for. So right now, I think we're getting into some serious consequences here with a market that's ran up from 2020, 2021. The higher you and faster you run, you could actually come back down fairly nasty on the IWM, which is not good. The SPY also, if you're looking at a longer term here, you can see right here, we're breaking. It's still short, meaning it's shorter term right now, but that could accelerate and pick up speed because we haven't had a downward trend for like a full year for a while. I'm not saying that's going to happen. I'm just saying we haven't had it for a while. So that could pick up speed later. I don't want to put fear in there because a lot of the news puts fear in there. So let's just be happy. It's kind of like a good, happy place, right? We don't want to be fearful about it, but we also want to be nimble, right? So after a bunch of down days, you'll probably expect some violent pops up. I'm not going to say it's going to happen next week or the week after, but you probably will expect that. So if you're doing stuff like iron condors, be very careful on that right call side. That's kind of dangerous to do the iron condor right now, even though you'll get wider because the VIX is bigger. You'll be able to actually get much wider. So normally, let's say you get a 300 point width on maybe like, pick your stock, ticker symbol, or 3 letters or 4 letters. Let's say normally you get 300 points. Now you might be getting 500 point width. But the problem is you're so far down that you're going to get that snap up that this right side could get in trouble. So right now, it's very dangerous for this right side, actually. Even if you put an iron condor with price being in the middle, you could get that snap up and that could be a problem. Now, yes, you could continue to sell off, but I'm kind of a little bit, less worried about it because we've already sold off quite a bit. So be a little bit more careful. Yeah. Hey, Pokey. Hey, thanks for joining us. So what we want to do is just keep a little nimble eye on things. And if you were, let's just say, looking at any kind of stock, you're always looking at now earnings. You got some nasty stuff that happened with Netflix here. And usually, again, as I say, 3 to 5 days minimum, wait before you get into this because everybody's trying to dump. Don't rush into these things. Okay, wait. So this stock pulled back. This was a $600-700 stock. You're down to almost 400. That price cut is now 44%. So if you were, let's just talk about it for a second. If you were a long-term investor in Netflix as a concept, and you were liking it at 600, and you were liking it all in 2020, 2021, if you were a long-term investor in it, then you probably would like it at 400 because this is just kind of one day panic, price-driven panic. So be very careful here that, if you're a long-term investor and you're looking for like a 10-year plus thing, then what you're doing on the option side is you're redo it over and over again with the number of delta that you normally would like to keep. However, you might do it with protection. Again, not today, wait 3 to 5 days and then go from there. Yeah, you're welcome, Daniel. All right, so how might we approach like Netflix? I'm going to go ahead and put a trade on the paper platform, even though probably Friday's not the best day because Friday, they already budget the weekend volatility in there. So the volatility already on the open on Friday is kind of adjusted for Monday. So that's kind of one thing. So getting filled as well. Also, we got a market that's very volatile. So getting into positions actually very difficult. I was doing some on my live account, a couple of different things. Actually, I think I just got some PNG stuff the other day, today. Yeah, so I got some of this, but again, it's very volatile. So anyway, so if I'm doing something on Netflix here, how could you approach it? And again, remember, all the volatilities are jacked up after earnings. So again, wait 3 to 5 days as usual before doing this. But I would do a longer duration. Why longer? Because I don't want the theta. I don't know when it's going to bounce. I just know sometime in the future, maybe 60 days, it might have a bounce. And if I'm a long-term investor, if I'm looking for, let's say, a 3-year plus kind of thing, 60, 80, 90 days, I'm looking for an upside movement, right? Long investor, if you like the stock at 600, you probably like it at 400, okay? But the issue with this is, okay, if I go about 56 days or 83, let's just say I'm going 83. I could do a couple different things. I could go in and sell some more puts, which means here's kind of one way to approach it. I go in and let's say I'm going to about a 20 to 30 delta, okay, 20 to 30 delta, somewhere around here. And let's say I'm doing selling a put vertical. Sell a vertical. Okay, so if I got a vertical, right? Now I'm looking for that stock to pop. And in fact, in theory, I'm getting this stock, and you can see it's kind of whipping around on me because I shouldn't be starting with a positive 20. There's just I think it's just volatilities, paper platform all over prices and spreads. Anyway, if I'm looking to get that stock and I'm trying to get a 360, 365, already it's a lot lower than where it is right now. So right now it's at 400. And if I'm looking to buy that stock at 360, I'm giving it more room to fall. So think about it. If I liked it at 600 or 650, and I should still then like it at 400, well, I could get it another from 400 to 360. I could get it 10% lower than even this, right? So in that case, from a long-term investor standpoint, this could be an idea. But here's the issue with this. I'm risking a ton of money with no protection. In a way, it is a defined spread because my risk here is defined at 383 to try and make 117. So it's about, 30% on your income or on the risk. And this is until April. So I'm looking for that stock to bounce. But how would I better do this? Well, I would probably convert it into maybe more of a back ratio spread. kind of like this, but unfortunately to do this, you need more capital, okay? So if I do more capital, here's how this will look. It's just because the stock is bigger, just to show you what the profit picture looks like. So we're gonna go with maybe, actually, let me do it the regular way for you guys. So that way you can see it. Let's go back to 1-1 spread. Okay, so how do I do it? I've got right here, 2 delta, 2 shares, in other words. And if I can't afford it, because I know not everybody can afford it, I'm gonna go to a really cheap put option and buy that as an extra hedge right here. And I might have to go to, let's go to 250s. Let's see, it's not even traded. 260s? Nope, I might have to look them up. 270s, 275 maybe? Nope. Okay, so let's open these up because they probably didn't price them yet. 310 is the best I can get. Wow. Okay. I guess they don't. 310 is the lowest. Okay, so let's go to 310, and you'll see how this works. So I got a 310. Unfortunately, I have to bump these up then to make it work, just to show you the concept. So let's go to 4 or 5. Okay, so this is how you would do it. Okay, so you're basically buying an extra protection, and because the spread is not combined, you're going to start a little negative. So because I didn't combine this yet, but you could combine it as a 3-legged spread. And what you're doing is you're trying to smooth out the curve. So that way, if it does pull back or keeps pulling back, even to 350, I don't take as a big of a hit. Because with 5 contracts, if I did it and it goes to 350, I'm losing $708. Okay, that's not accounting for time decay. But if it does pull back and I have that extra put for protection, I'm only losing 184. Now, granted, it reduces my profit, but if I'm a long investor, I'm looking for that stock to still go up. So this is a good opportunity for kind of like a buy the dip to try and make, a little bit of extra income or money. You could also tighten these up a little bit to, let's say, 380, 385. Here, let's do that. And now that gives it a little bit more profit potential. So here I'm trying to make 285. I'm risking 2,000 or so. So I'm trying to make about what is that, 10, 15% or so on your money. But again, I'm smoothing out that curve right there. It makes it much smoother. And I did this actually, just so you guys are aware, if you want to look back at the videos on Peloton, I tried this like multiple times. Just look back at the other live videos and you can see this trade. I had to even reset this one, but the hit, you could see this stock is selling off pretty nasty, but I'm not getting burned as badly on this because look, I was trying to make 242 on it over here, but because it overshot it so much, it's just even worse. I'm not even losing that much on the stock. Now, yes, the theta is starting to kick in because this is our sea of death over here. This is a huge issue. So if it hangs out, but remember, the sea of death only happens at expiration, and that's what people don't get. So really, if you're looking at it, don't get fooled into thinking of the expiration stuff. We're looking at more like a day step. So if I look at the day step, the way that this stuff behaves, I'm really just looking at the behavior of the curvature of the risk. And that's what you want to do, is because people get too wrapped up, oh, I'm going to die big time. Well, yeah, you'll only die, but at expiration here. Otherwise, you might still be here with a lot of premium. And the point is to smooth out that curve here rather than to get a big dip. Okay, so that's the type of spreads maybe you might want to consider if you're trying to buy the dips or buy on value and so on, is that like, you're putting on something like this Netflix trade, and you're trying to smooth things out right here so that way you don't get a tumble or get into huge trouble. You could also start it with selling a vertical or something like that, or even buying a vertical call and then getting that put later in a few days, but that's just kind of adding a little risk. Okay. The gamma iron on Uber we did before. This one's working out well. You can see because Uber just moved, markets crashed. So this is one where you're kind of taking profits off of. So again, you're risking 121, trying to make 45. Doesn't matter where it moved. The big issue again is the sea of death. And you can see you can't be scared of that theta. The theta is going to happen. But you just have to understand that I don't want to stack too many trades with negative theta. If you do that, then that will become a problem. But throwing a few of these on here for stuff like this is a hedge. This helps hedge off a lot of the bullish positions or other positions, because otherwise, If you're all bullish or all bearish, you got problems. But having and throwing some of these in helps reduce the risk. So instead of losing, let's say, 5,000 in a day, you might lose maybe only 2,000 for that day. So it's not that you won't lose, it's just you'll lose less. So you want to close that off by now. Kind of, it's getting in there. There's no reason to kind of hold it, because what if it snaps up? So you're letting that trade kind of work. Now today, I know I'm down a bit on this portfolio, which is fine. You know, I mean, we've got a lot of long investments here. Those are down quite a bit. So that's about half of the down move of this that I have. And I've got some stuff expiring in Visa, which is kind of a full loss there. So some of these spreads, they will take a big beating. You can see this hedge on SPY, how much this really helps. So look at that hedge, boom. Sometimes they work out really nicely, and that's why you do hedge, because otherwise I'd be down even more. So that's when you put those on. Let me see what that was, but I'll probably take a lot of those off, and you can kind of look at some of those other videos. So here we did like 6 contracts. There you go. You could see it's basically putting on some bearish spreads for a longer duration for a possible pullback. And this one's panning out fairly well over this last week or two. Okay. And then I put some XLE bearish, because the XLE was moving. You can check that. It was moving really, really high. And I'm like, okay, let me put on a spread maybe for a little pullback. And the same thing here. If we look at the XLE, which is the energy, it's kind of just starting that move down. But if we do keep selling off, you know, it's a $400 trade or so. Okay, so what other things can you think about as you do a market like this? Well, a lot of people, as they trade, let's say stock, like let's say you have stock in Home Depot. What some people think is right now is the time to buy a put. And I will say it's usually not a good time. It's probably the worst time to buy a put. The time to buy a put was like a month ago. So here's why. And I get this question a lot, so I'm going to cover it. Okay. Hopefully it makes sense. If you guys know it all, then just tell me to move quicker or move on, and we can skip this one, but just let me know. But I'll cover this because it's fairly basic, but I don't think a lot of people understand it. So let's say you have 500 shares of Delta, or 500 shares of the stock, and you know you're in the stock, and then you're looking to buy a put. Like now at the 330, like your stock is crashing. Like Home Depot's been crashing quite a bit. Like if you look at Home Depot, it's been pulling back, and it's moved down quite a bit. You're now realizing, okay, I want to buy a put. I want to buy a put. Okay, well, there's a couple problems with it. Number one, puts are very expensive now because you've been going down. So now the volatility has been increasing, which means put prices are higher. Okay, so puts are now more pricey. Okay, if you wanted blueberries in the summer, let's just say it's $4. In the winter, the blueberries might be, let's say, not realistic, but let's say $10. You know, but they skyrocket in price. So that's what happened with these puts. So let's say they were whatever for a spread $3. Now they're like $6. And you're going to pay up for it, for that protection. That's kind of number one. Number two is that since we're sold off so much, we might actually get a snap up to certain other levels. And that could be the place to buy your puts, is when you get that snap up. When you snap up, and then the volatility will come down a bit, and you'll be back up here, maybe even halfway to that retracement. But if you get it now, like let's say you get your puts right there, you also have a volatility crush that happens. Okay, volatility crush, that'll happen. So think about it. If I go in and now I buy some puts like 42 days out, and I'll get like, let's say the 320, I buy a single. Okay, so look what I'm doing. I'm actually getting long volatility, 32 Vega actually. And if I multiply that times 5 contracts, let's say it's 5 shares, that's 163 Vega. So I actually need volatility to go ahead and increase. My theta is 67 negative, and I got a downward direction of 95 shares. So what you're noticing here is I'm basically combining more volatility. And when the stock pops, that volatility drops, and I'm going to lose a lot on these options. So that's really a bad time to do that. Now, what's the alternative on this? Okay, here's another idea. Okay, so as we look into something like Home Depot, you might say, okay, well, what does this look like? If you're not long any stock, right here, what does this look like? Does that look like a call? Bada bing, right? So what people don't get is when you have stock and you buy a put, you're actually basically buying a call. So if I buy this call 42 days out, you're basically protected at that price. It's a synthetic position. Here it is, a synthetic position of stock plus a put equals a call, right? So let me write it out for you. Stock plus a put equals a call, ironically enough, right? So you defined your risk and you got some upside potential just in the same way as you would, because you have a put under it. In other words, you have kind of that protection. Okay, so, but again, this is a huge problem. Why? Because you got a vega. So as this grinds to the upside, volatility will compress, and that means this is becoming worth less and less and less from the volatility offset. So again, not always as useful. So what is more useful or more in line with doing some of those trades? Well, I showed you the back ratio. That's kind of one of them. The other thing that you could do is try and do a defined risk spread. Okay, so, and that could be something like a right at the money. And I say at the money because you don't have any theta or vega to kind of deal with as much. So now what you have is right there, no theta. You've eliminated that risk. You've eliminated vega risk. You're right at the money. So you're risking 1 to make 1. And it's a lot more defined. However, you got to make sure you check the skew of what makes more sense to trade. So if I do this spread, okay, and then let's go into this spread, okay, let's go buy this spread, and then we'll buy a vertical here. Okay, these spreads should be equal in price. The three, let me change the strikes to make sure we got even 355 and 350. So these spreads should be very even if everything was aligned because of they're tied together. Okay, so, but the problem is here is we have a skew, which means the call spreads are more expensive. So if you're actually going bullish now, you're going to be paying up much more than you are on the put side, ironically enough. So you need to be mindful that, hey, if you're doing a call spread, you got to really watch your orders. Okay, really watch your orders to make sure you get filled on it very well. If you don't, you could have some issues there and, overpay. So doing a spread like this eliminates some of this vega and theta risk. And that's one way of approaching it. The other thing you could do is if you actually do have stock, what most people don't understand is you could actually go deeper into selling some things in the money. And it's like, well, wouldn't that stock be gone immediately? No, usually it wouldn't be gone till about a week before expiration, because the people that buy insurance, they want to hold it in. But let's say I go in like 14 or 21 days and I go in actually deeper in the money. Like let's say I go into the 330. All you're doing is you're closing in a way. Let's say you have a profitable position, right? If I bought these shares much sooner, like at the 300, and now I sell a call at the 330, okay, I'm actually going in the money at 330 right here. But look at the premium I get. Okay, so I get a ton more premium. Let's just do one contract here. Okay, there's one contract. Okay, so what a lot of people do is they sell that call, but they sell that call maybe more at the 360 or 70. So let's say 360, because they don't want to lose their stock. They're worried about like tax implications. But they only collect $385. Okay, so they're collecting here $385 at most. Okay, so they're $395 in this case. Okay, but what I could do is actually go in the money by 10, 20 points. If I'm really worried about the crash, why don't I go in and go like to the 340 and collect $1,490? Well, why would you do that? Well, because this price actually includes the difference of this So that way, my difference is none, really. I just would lose the stock. You're making it back on the premium. Even though you lose that stock at 340, the premium makes up for it. So don't worry about that. But yes, if you're like worried about taxes, well, in that case, you might not want to do this. But what you could do is go ahead and set up something like this. Is go in the money, and you could go a little deeper. You could get a little closer right here. Get a little closer on this one, 330, 335, and now you're making like, $2,000 in premium. And if the stock pulls back, you're smiling still. It's not that you don't lose money, but you lose a lot less. Because look, you're reducing your delta by 82 here, okay? Because you got 100 delta from the stock, 100 shares, okay? I'm reducing it by 82. So it's not that I won't lose, but look, I lose a lot less. I'm only carrying 20 shares of stock right now. But if I did one out of the money, I'm carrying 66 shares of stock in theory, because I'm selling at the 360 premium. I'm only collecting $395. I'm only collecting $395. So I want to get closer in to collect more, because this one only reduces me 33 deltas. The one at 360 or out of the money. The one in the money reduces me by 81. Could I go with somewhere in between? Yeah, I could. I could go kind of like right at the money as well, or somewhere there, reduced by 33. But the goal is to cut your exposure for the downside, if that's what you're worried about. The other thing you could do is, if you have a lot of shares, like let's say you've got like 500 shares, okay, and then you've got, let's say, a couple different contracts. You could spread these out across different time frames, like 340, 370, and let's say we go to another expiration like March 4th. And what you'll be able to see here is, it's all spread out to keep cutting deltas. All right, so one is March, let's say May 20th. So there we go. So I'm spreading it all around. And again, my goal is to just kind of cut that delta, and you're cutting. So you think, okay, I've got 2, 4, and let's just do 5 right here. I've got 5 of them. But could you do more? Yeah, you could. You could actually go in, and let's say I go in and do more and more and more. And look, now I'm cutting my delta to 54 from a 500 lot position in shares. I'm actually cutting it even more. Now, again, you probably want to spread your risk to different areas, but the goal is to cut that delta. The problem with this is if it explodes back up, you do have some trouble, but you could actually sell more than you have. Not a lot of people do that, but you can do that. It's because they don't know about it. Hey, Cameron, I've been selling put spreads since last week. I'm able to get further away from the market every day. The VIX increases. Well said. Yeah, thank you for sharing. Yeah, Mercy, you're welcome. Okay, so here's one more tidbit I want to leave you with on this, is how to pause the stock. You just go to your VCR and hit pause, and then it won't move. No, I'm just kidding. Okay, so if you have stock, okay, this is a delta position of, let's say, 300. Okay, so it's wiggling and wiggling and wiggling. And let's say you got a hurricane coming, or you got a thunderstorm or snowstorm. How do you hit pause? How do we hit pause on this position? Okay, so what we do is, let's say I wanted to create a synthetic position, and I'll just show you what synthetics are before we get too crazy. Let's say I am doing this 56 days out, and I'm going to go single order. All right, so I'm going to sell one. I'm going to do at the money first, and then let me see, sell one, not sell one, sell one. Sell one of these, buy one of these, okay? So what this does is it's a combo. It's known as a synthetic position. So take a look. I am now short 100 shares of Delta stock from synthetically selling one call and buying one put. Interesting, right? So I am basically selling one and buying one. Okay, very different. Now you might need a different account status. I don't know your personal account situation. Portfolio margin, you have no problem doing this, but here's a cool way to pause kind of the stock. So here I've got let's say I've got 100 shares of stock. Okay, I'm long 100 Delta. And then I get this spread, I'm short 100 Delta. So if you want to wait till the storm is over, right? Border up your windows, that kind of thing. You've got stock, and wherever you are, look, stock's moving up. If you're profitable now only 1,000, you were profitable too, and you say, I want to just stop it. I want to stop the pain. Boom. There's a synthetic position. This is more advanced, but look, no matter where this goes now, you are paused. That's it. You're done. You're pausing. Let me check out for 3 weeks. Let that market do its thing. Let the storm pass, and I'm out. So it's a cool little trick. I mean, you know, not everybody does it. Again, it's more, how should we say it, more advanced. But I want to show you that, like, you know, in these live streams, like, what's possible. You know, a lot of people just chitter chatter about news and stocks and this kind of stuff, but when you're actually doing the trades and you're actually putting stuff on, this is kind of what you're looking at. If you had, like, let's say 300 shares or 400 shares of stock, you could, like, you know, cut your delta with these synthetics very quickly. You could even go short a bit for temporarily and then start peeling these back if you wanted, but there it is. It's paused. That's it. Your delta is now 0, basically. Yeah, you got some time decay problem, but nothing major. So your risk in this position is now basically like 484. So whatever it was, if it was $2,000 that you were up at that time, you're pausing. Okay. If you were down like 3,000, you're pausing. You're like, hey, I stop the pain. You're done. You're pausing till the storm is done, right? So if you got this nasty hurricane spinning, okay, you're kind of waiting for it to pass, and then you're like, okay, cool. Then I'll reset my position once the conditions are better. I hope that makes sense, because, you know, there's different market conditions. You might have a market condition where it's like nice to put on vertical spreads. Nice, let's say another condition might be like very sideways market. And then you might put on, like, you know, movement type spreads. Another condition where you're just grinding up. So you got these different conditions where you got different strategies that might work in different conditions a little better than others. It's not to say you can't have long investments in like a snowstorm, but what you want to do is like chop it down a little bit, right? You want to just kind of cut it. And this is kind of another way. Anyway, I hope that helps. I hope it doesn't confuse you guys. I just want to share with you some more tidbits, a little bit more advanced here. I don't always share like some of the advanced stuff on YouTube on this, just because there's a lot of new people and just over their heads. If you want to really get some training, then check out that website, the Traders Fly website. There's a lot of stuff that you can go through there, and, you know, grab yourself a course on just the basics of options. This one's like 11 hours long, so it'll give you a really good foundation in that, and you can see that on, you know, tradersfly.com. It'll route you to our Rise to Learn. And definitely check out the Discord group if you have any requests on any stocks or tickers. I've been doing some of those more on my Critical Charts channel, just to play around with a lot of some new content on the technical side, because I find that a lot of people are just doing some of the charts but don't get the charts, but they're doing the options. So you don't need to know the charts to deal with options. You need to understand probabilities much more, but the charts kind of help give people a little bit more of a perspective. So you could check that out and just see what's going on and happening within the chart perspective. So anyways, I hope that helps. Any last final questions? I'm going to head for lunch here. This market's kind of dead a little bit, and there's just rolling over. I also have a swing trading thing scheduled. It's going to start. All the people on Discord will get notified. We'll be doing that in probably about 2 weeks. I think like February 7th or something. Not the Valentine's week, but it'll be evening time. So you can check that out. We're going to do a lot on the technicals. So anyways, I hope that helps. Enjoy the rest of your week and weekend. Happy Friday. Thanks for joining me. I'll see if I'll do a couple more videos later today between some of the trades I'm doing. But I mean, portfolio wise, yeah, it's a little tricky with these situations, and you just be careful with a possible snap up on, you know, what's going on here. Cause I got like a Roku trade here, and that one's going to be dead. I could already see it. Like that's going to be a full loss. But that's what you do on these spreads that kind of, you know, you put on a probability trade, and already I got February 11th. It's pulling back. It's nasty. It's speculative, but that's why we're kind of lighter on those. Swing directional. You know, this Peloton. I mean, there's a lot of bullish stuff in here because that's how typically we deal with in the coaching side. But you want to deal with some of those with protection, right? So like stuff like Peloton or the Uber one, which is, I would guess that one got filled maybe. Yeah, Uber got filled. So you're just kind of working those orders much more closely. So anyways, yeah, yeah, you're welcome, Napoleon. Yeah, hi, Kevin. Let's see, we got another one. Reiner, I just fired TD Ameritrade, went with AMP futures, cut my trading fees by 40%, better margins. Okay, well, great. Whatever floats your boat. TD Ameritrade is really good for a lot of people, I find. I mean, now the Schwab Tastyworks is probably the other alternative. I wouldn't really use too many more for people starting out, just because you need the technical support and all that kind of stuff. So, okay, appreciate it. All right, have a good one, guys. Thanks for joining me, and